Welcome to TradeProFX, where we bring you expert strategies for trading Deriv Volatility market. So today I'm going to walk you through an amazing technique known as the liquidity grab. It's very simple, but potentially can maximize your profits when you take advantage of the market inefficiencies. So I will just dive to a good time frame, which is 4 hours. So before we dive into the strategy, let's just look at the unique opportunities where the Deriv markets offer these. The synthetic markets, they mimic real markets. They only just mimic real markets, but without external influences like the news or earning reports. So this makes them a perfect for technical analysis strategies like now what I want to show you, which is called the liquidity grab. So exactly, so what is a liquidity grab? So let's first find out what is a liquidity grab. That's what we want, a liquidity grab. So liquidity grab in the market refers to areas where the traders have placed their stop loss, often around the swing lows and the swing highs. So when the price attempts, so whenever you see, you just identify prices. So whenever you identify the swing highs and the swing lows, that's where the prices attempt to break these levels but fails. So I hope we are together with that. So that those are areas where the market tries to break but it fails. So we can spot some of them, like you can see like this one here. That's where the market wanted to make an uptrend, and but for this swing high, the previous swing high and these swing highs, the price never went up, and that now happens, and that's the liquidity. That's where the liquidity grab happens. So for the smart traders who know this is an ideal time to enter a trade, they can just place their trade and move with the current trend market. So just as I've told you, let's just jump into the first step of the strategy. So the first step of the strategy is by first marking the swing low. So let's just look for one entry point that we can see there is a potential of such a kind of a swing low. So you can use any time frame, but mostly using the higher time frame is better to spot such kind of entries. So I can just advocate for higher time frame, but also for the 15 minutes. For the 15 minutes, you can use it to find for those areas. So number one, I've told you, you start by marking the swing low and the swing high. So I'll just come, let's utilize this part here. So by marking the swing low, which is that point, you see, and then I will come and mark the swing high of that, the current, this movement here. So this is the movement I've marked, the swing high and the swing low. So with that, you have first known the first way, you first step to mark and identify a liquidity grab. So by first marking the swing low and the swing high levels on the charts. So after marking those two lows and high, these are the points where the market reverses. This is the point that you have noted the market keeps on reversing. So we expect the market to either reverse from this point or this point. So that's why we have marked our swing high and our swing low. So this potential, these are points where the market reverses and traders typically place their stop losses or take profits. So with that, now looking at those current prices, you can note the current price. We are observing both the swing low and the swing high. So we will be waiting for the market. Now from here we are assuming these candlesticks have not been formed, so we are expecting either the market to break that upper part or to go down, break the lower part, and we can now identify the liquidity grab, and the market began going downward. So assuming the market, you have found the market at this area, this was the price you decided to mark your swing high and your swing low. So I'll be waiting for either the market to move up or move down, and with that we are waiting for that market either to test and attempt to break the swing low, which is now this part, and without success we now see that we have now entered by grabbing that liquidity which is low. So the second step is all about the confirmation. So once the price dips in the below, as it is here, once the price dips below the swing low but fails to hold there, it's a time now for the confirmation, and we want to see a strong candlestick which is on the bullish side close above the low to close just above the closing price of the candlestick which is on your right, which is the bearish candlestick. So when the candlestick crosses above the close of that candlestick, we want to see a strong candlestick then cross the low to the signal, and then the grab is complete. And you can see this candlestick crossed above where the market closed below. So we said for the bearish candlesticks we normally open from here. That's how we talked about. The candlestick opened here and then went up, created a small wick, then went down, created a wick, and then closed. So the next candlestick, which is this bullish candlestick, opened from there, went down, then went up and closed. So it closed above that bearish candlestick, and showing us there was a good grab from that side. So now once that you have now confirmed and you are ready to enter, you will enter using the next candlestick, which after this one has crossed above the crossing of that candlestick. So that will be your entry point, and then where will your stop loss be? Just right below the low tip of that liquidity grab. This is the place you will place your stop loss. And what is your take profit? Your take profit will be the first high, which is that area there. So what did the market do? Went straightly up, then retested, and the market will never touched your stop loss and went up. So this is where the idea of the retest comes in. So whenever you identify a market has already made that liquidity grab, you wait for the market to go up, then come retest to that same area, and then now this is the opportunity you can now pick for a trade. We have discussed that before, so if you have not watched that YouTube channel on a video, you can do so. So the third step is very crucial, and that is what I've talked about, how to place your trade and the stop loss. So always ensure that your stop loss is just below the wick of the liquidity grab candlestick. So that's how we put our stop loss. Just that, it's very simple as I am describing it. So you just place the stop loss just below the wick of the liquidity grab candle. This way you protect yourself from the sudden unexpected moves that might shake your trade, and those sudden moves are like this retest here. So that's why we place our stop loss below that, just below the wick of the liquidity grab candlestick. And remember, managing your risk is just important as finding the right entry That's why we have placed our stop loss there. It is safer on that point, and your take profit on the first recent high. This is where the market often returns after the liquidity grab, giving you a solid opportunity to get some profits. And after you grab that profit, you can now proceed adjusting your stop loss to the break even. So if you had entered that trade, you just adjust to the break even and proceed capturing that entry point. So that's how generally you identify the liquidity grab. Very simple. You just adjust. After that, you just adjust based on the market conditions, but aiming for the most recent high. And that's the key point, and you should be patient. You remember we said trading requires so much patience. So that's it for today. You can see after you use the same concept, you can get some good trades. We can maybe check for another area here after identifying the first identified. Let's try and look for something like the 15 minutes for whether we can see that those liquidity gaps. So I've told you the first thing you just find for the first so let's see like this one. So you have marked your first recent low, which is that point, and your first recent high, which is that point, and then you wait for that market. So assuming you entered when the market was still here, and you have already marked your swing high and your swing low. So what are you waiting for? The market to come down and show you that now there is a candlestick that has crossed above. So we said the candlestick of this one has opened at that area and then closed at this area. What did the next candlestick do? Came up and closed above the close of this candlestick. So it has closed at that area. So what will be your entry? It will be on that point, on that candlestick, and your stop loss on that area. What is your take profit? On your first recent high, and the market went hit our take profit, and that's the power of the liquidity grab strategy. But remember, every trade won't be perfect. That's why managing your risk is practicing a good trade management, and that's very important. So as always, stay patient and remember to backtest always your strategies so that you can get to understand these concepts and before you join to trade with your real account. So with those few remarks, always stay safe. And if you have enjoyed the liquidity grab strategy, kindly press the like button, subscribe to TradeProFX, turn on the notification bell so you will never miss our latest content and succeed together in these volatility markets trading. And happy trading. So let's meet in the next video. Go try to identify those key zones.